I think if I could ask people to take their seats, that we should probably get started on this panel. We do have time, and I'm sure there will be some people who are wandering in, but if we get started, that might encourage them to wander in quicker. Let me begin with a short introduction. First of all, to myself and my background, and to the panel and what we're going to be discussing. So my name is David Pitt-Watson. I'm co-chair of the UN Environment Programme's Finance Initiative. Now, that is a coalition between the UN and about 220 financial institutions around the world, and our aim is to be a catalyst to change. We're often working with people, or indeed helping establish organizations that can allow people to work together. So, for example, the principles for responsible investment, the principles for sustainable insurance, the sustainable stock exchanges, fiduciary duties initiative, all I hope somewhere back there have got our fingerprints on them. But the aim really is to help us learn from one another and to help us work together. And what we're trying to do this afternoon, and what we've been trying to do for the past many years, isn't really terribly radical. It's about trying to get finance to do its job properly. There's one definition I love of one of the principal purposes of the finance industry, which is to take money from point A, where it is, to point B, where it's needed. And I would think that most people in this room know exactly where point B is, where money is needed. It's needed to create a world which is sustainable for us, for our children, and for our grandchildren. And we know that if we're going to do that, we're going to need money. We'll need about $1 trillion a year, it's said. Depends how you do the numbers, but I rather like the notion that there is a clean trillion that is required. Right now, of that clean trillion, we have about 500 billion that is being spent on renewable energy and on adaptation, but we've still only got half of the money that we need. Of course, we know from earlier discussions that we've had today, that if in the blue zone we get an agreement on the pricing of carbon, then of course money will start to flow. Indeed, there are $25 trillion of investors who have petitioned the people negotiating in the blue zone that they want to see exactly that happen. But there's also something that we should be thinking about as private companies, and particularly as financiers, which is about the machinery of finance. In the green zone, we need to be thinking about how well the finance industry has designed itself to take money from point A, where it is, to point B, where it's needed. And we know it's not doing a good job. We know it's not doing a good job, not least because $500 billion are invested every year by private carbon companies, discovering new carbon resources that we know, because the scientists tell us, can't ever be burned. It's simply money down the drain, and it's money that if its investments are ever used, will destroy us. Indeed, Bloomberg even went so far as to suggest that the finance industry we have today is institutionally fossilist. In other words, it will prefer to be investing in things brown than in things green. We have a world where historically it's been the duty of investors to think of their fiduciary duty as only being to maximize short-term returns. We have a world where until recently there was no information that could allow investors to judge whether or not the companies they were investing in were green or brown. We've had a world where we regulate for risk, but we don't regulate at all for climate risk, despite the fact that not just the head of the IMF and the head of the World Bank, but the head of the Financial Stability Board tell us that it's catastrophic if we don't. So look, we're on a journey as UNEP-FI here, as are, I think, most of the people that are in this room. And our aim is to learn from one another and to work together, because we've got a long journey here. And as the Chinese saying goes, if you want to travel fast, you go alone. But if you want to travel far, you go with others. And I have a fantastic group of others with which to have a discussion and a debate about what it is that is going on in our world and what it is that we need to be doing in order to improve things. First of all, I have a group of investors. I have Wilhelmine Verdegal from MN Services, Helena Venus Fiestas, who works for BNP in their investment area. I have Daniela Saltzman, who's the third to my right here, who works for Generation Asset Management. I also have in Caroline Hill, who's sitting third along, you can tell because they look at me and smile, which is very nice, a proper company that is trying to deal with these issues and to have the right relationship with its investors. And with Sophia Kerrison from DG Justice of the European Union, a regulator who's trying to make sure that these things work. With Alice Garton, who's the 5th along, a lawyer from an NGO called Client Earth that takes the earth as its client in making sure that companies and investors are doing the right thing. And I have to say, my last person on my panel, I'm really pleased is here, not just because Nathan is great as the Director of Policy at the Principles for Responsible Investment, but often I chair panels where there has to be a token woman on the panel. And I am so delighted that Nathan can be a token man on this. And of course, the Principles for Responsible Investment are trying to bring investors together to think about how it is that we do the job properly, that we take money from point A, where it is, to point B, where it's needed. And one of the things that's required for that is to be sure that we understand what our duties are to our clients, that we understand as a finance industry that there might be something more than short-term returns that need to be thought about when you're investing. Now, Nathan, you and actually UNEP-FI as well have just completed what is something of a landmark study on how we get that system to work well through a legal concept known as fiduciary duty. I wonder, could you tell us a little bit about what that is? Where does it take us?
Good afternoon, everyone. What we did was examine investment practice, regulatory regimes, and took legal advice in 8 countries around the world on the question of investor duties in the form of fiduciary duties. Now, those of you who work for companies will be very familiar with director duties. There are 2 duties that are relevant to investors, that of loyalty and that of prudence. When we are being loyal, we are acting in the interests of our beneficiaries, and as that happens, that's all of you, through your pension funds and your individual investments. When we are acting with prudence, we're acting with due care, skill, and diligence. And through our research program, we found that because ESG, or environmental, social, and corporate governance issues, can be material, there is in fact an obligation to prudently incorporate them into investment practice. Now, those of you familiar with the director's duties conversation over the last 15 years will be aware that sustainability factors have long been considered to be part of director's duties, but mainly in the interests of avoiding a separate positive duty. So, the fact that ESG, or climate change in this case, is part of fiduciary duty is not really news. The new part is that it is clear to us, and the lawyers who are advising us, that there is now a process test around whether or not, in fact, a trustee has been prudent. And so what that means is that you must demonstrate due care, skill, and diligence in the way you consider climate change. No longer is it acceptable to get your information from popular newspapers. You must in fact get your information from expert scientific opinion, from properly performed economic analysis and informed financial analysts. You must stress test your portfolios to consider climate risks. You must require 2 degree or less than 2 degree of warming business plans from the companies you invest in. And if you do not, you must ask how you will mitigate any risks that might arise from these companies not making the transition to an economy with less than 2 degrees of warming. This is an important, and we would say landmark development in the understanding of fiduciary duties, and a clear step forward from where we were 10 or 15 years ago.
So Nathan, that all sounds fine, but I chair it's a small by global standards, but a few £100 million charity endowment. We're maybe invested in 5,000 companies. What's my fiduciary duty?
Your duty, if you use an external funds manager to invest for you, is to have a process for ensuring that they assess each of those 5,000 companies.
And you would say that's what the law says?
The law will say that you must demonstrate diligence and prudence in your process. Now that means understanding if the companies you invest in have a high exposure either to climate risks or to emissions. And so someone in your investment supply chain has to know the answer. It's not good enough for you to say, we've got 5,000 companies, it's too hard for us to know the answer. That's the difference.
Okay, so I need to do that because if I don't, this sounds a silly question. I need to know that because if I don't, I destroy the planet, or I need to know that because if I destroy the planet, then my endowment's not going to be worth very much.
The latter. It's a duty because climate issues can be material to financial performance.
Right.
You have a duty to properly assess them. And the evidence on climate especially, but also increasingly on other environmental issues, is that there's clear scientific information, there is clear economic analysis, there is a clear direction of travel on policy. How much more information does a prudent person need to make a proper judgment about the direction of travel? And so that is where the obligation sits. So
that sits the law in quite an interesting and different position, I think, than many people currently interpret it. But, it would always be, it seems to me, quite in your best interest as an investor to start thinking about the environmental sustainability of companies that you're investing in, because sustainable ones likely to last longer. We had Mads Anderson and others this morning talking about this. But Daniela, you come from Generation Asset Management, David Blood and Al Gore, the partners in starting that. That's been basic to what you've been doing for a number of years. Why have other people not done more?
Well, I think it comes down to the fact that the investor community has yet to fully recognize that sustainability factors are truly fundamental, long-term drivers of financial performance. So there's quite a bit of research now to this point, and we've aggregated what we think is a very robust data set and published it this past May in a white paper called Allocating Capital for Long-Term Returns. So in the paper, we effectively outline what is the business case for including sustainability into your decision-making practices as an investor, and what are really the drivers of change globally that are trends really influencing the uptake of sustainability. Things like population growth, rapid urbanization, carbon risk for sure, and how these, again, are increasing the importance of integrating sustainability into valuations. So really what this tells us is that the sustainable, low-carbon economy that we're going to move towards will look nothing like the economy we currently live in. And as a result, fiduciaries of capital must update investment frameworks to reflect this shift. Because effectively, fiduciaries can do three things. They can buy, sell, or hold assets. But there's no passive behavior. There's no do-nothing task. So if a fiduciary decides to ignore sustainability issues, effectively, it's the active omission of key contributors to financial outperformance, because we've already demonstrated the business case for sustainability issues. So put simply, ignoring sustainability could be a breach of your fiduciary duty. which is why we were really thrilled from an advocacy perspective within the Generation Foundation to partner with UNEP-FI and PRI on the implementation of this new report, Fiduciary Duty in the 21st Century, that makes the definitive case, it's truly a landmark study, as to why sustainability must be included in fiduciary duty, what it looks like across jurisdictions. So this initial study goes through 8 different countries, including the US, the UK, Canada, Germany, I think Japan. And we're now going to spend the next couple of years in this partnership rolling out how we can better engage with investors to, more than anything, shift mindsets, actually, as opposed to necessarily change law, to clearly define again how embedding sustainability is just a key part of thinking about fiduciary obligations. The second part of the implementation will actually expand this framework into Asia and key markets there, including China and Hong Kong, Indonesia, Malaysia, India for sure, and think about, again, what are the key issues there that we need to think about that, of course, need to be tailored to a jurisdiction by jurisdiction basis. And the last part of what we'll be trying to achieve over the next 24 months or so will be an international agreement to, again, harmonize our views on how do we define fiduciary duty in a way that incorporates sustainability at its core.
That's great, Daniela. And you know, at these COPs, they love to have lots and lots of announcements. I think you just made an announcement that that had not been announced before, that this fiduciary duty work will be going forward, because this is, for those of us in the audience that have got grey hairs, will know that when we started talking about responsible investment 15 years ago, fiduciary duty was a barrier. These legal opinions are suggesting that fiduciary duty, far from being a barrier, is actually the bridge that can lead us in the right direction. But I wonder just how practical all of this is. I mean, Caroline, you work for a real company. You know, one of the things I often get when people are talking about finance is that they think it's the financiers that make the investments. No, they don't. Actually, you work for Land Securities, biggest property company in the UK. It's you that decides what it is that a property is going to look like. 40% of our energy burned on property. How much influence do the investors have, and how much can they have? Don't they need an awful lot more information and an awful lot more engagement for this to work properly?
Well, I think investors can have a really key influence. So if I look at Land Securities, for those that aren't familiar with Land Securities, we're a real estate investment trust, primarily 2 portfolios, the London business, which is mainly office buildings, and a retail business, which is shopping centres and retail parks across the UK. And we both develop and manage our buildings. And sustainability is really key at Land Securities. It's about future-proofing our business. So we do this because we want to be around in the future. We want to address all of our stakeholders' concerns today, so they want to do business with us tomorrow, and investors within that are a key group. And one of the things that we think is really important in order for investors to be able to make sensible decisions on that is to have a common reporting framework within financial reports. And so for that reason, we are a signatory to the Climate Disclosure Standards Board reporting framework on climate change. And on this slide, you can just see a bit of detail about that. But it's been around since 2012, and to date, 140 companies have signed up to it, which are collectively worth about $2 trillion. The framework is really important to us at Land Securities because it sets out this common framework that all others that sign up to it should follow as well. And it asks companies to not only report on their performance, so your actual absolute emissions, but also really the strategy around what you're doing. So if I look at us, it's very important for us to look at the regulatory environment. And so within the property sector, that would be things like minimum energy efficiency standards in buildings and what we're doing to address that. It's important for us to look at physical risks and opportunities. So with the UK portfolio, we need to start looking now at flood risk, which we're doing across our portfolio, and what we need to do with our assets to prepare them for future changing weather patterns, and also looking at reputational risk as well. And if all companies reported that in a similar framework and way, it would be easier for investors to make sensible decisions on that. And looking at performance disclosure, it's also important for companies to not only report actual GHG levels and their emissions, but to also have discussion around movements. So looking at land securities, we've recently signed up to the RE100 campaign. As of April next year, all the electricity throughout all of our portfolios will be fully renewable. And so this is going to obviously have a very positive impact on our GHG emissions when we report in our annual report. But for us, I think it's very important for us to disclose that and be very transparent about that. That's one step we've taken. That's going to have a very positive impact. But it's important that investors see the change in our emissions what's as a result of moving to renewables and what is as a result of our very active energy management that we have across all of our buildings. Looking at changes in investor behaviour, I think there's been a noticeable shift this year actually in terms of the amount of questions we now get from our investors. It's significantly increased. We track every time we have a question from an investor related to sustainability. We do keep a log of that, and particularly on climate change, we are getting more questions on our carbon targets and how we set them, and a little bit more detail there. And I think what our investors then report back to us and what they want to see us doing does have an impact. We are currently reviewing our sustainability programme and have gone out and done a big stakeholder engagement piece with all of our stakeholders, so our investors, our customers, our staff, our communities and other partners as well. And the feedback we get from that will very much shape our programme. So we do welcome involvement from investors, and the RE100 example I gave earlier is a good example where what's going on in the outside world and what our investors were asking us to do then impacted our decision making.
So would it make a big difference if every time your chief executive went round on his or her journey around investors, there was 5 minutes was spent on just exactly what you're doing on carbon?
Yeah, absolutely. And
big difference.
Well, I think it just gets the discussion going, and so as part of the engagement exercise we've recently completed, we actually asked all of our investors, how do you want to engage with us? When do you want to hear from us? And we had different answers, but us being mindful of that and trying to include more disclosure within the regular round of engagement we have with our investors is really important.
Do you think it affects the share price?
I think it's sort of early days to really comment on that.
Okay.
I think what is noticeable is within the property sector, I think it's the companies that are doing nothing that are standing out, and I would imagine it would be affecting their share price. I think
so if you're not doing anything now, you're really behind the curve.
Yeah, then I think you stand out. I think the companies that are taking action, whether it would then increase your share price, I think it's a bit early.
Great, thank you. So let me now move to you, Alice. So look, you work for an NGO that is using the law to try and push companies, governments and others towards being more conscious of sustainability. How does all the stuff that you've heard from the last three speakers fit into this? Does it sound real, or does it sound like greenwash?
It sounds very real indeed. And in fact, what we're doing, so although our name is Client Earth and we act for the client in terms of its interests, in this circumstance we're acting for the pension fund members. So when we talk about institutional investors being at the top of the investment chain, in a way it's the beneficiaries who are, because the duties are owed to them into how they must manage their money, so the duty of prudence, duty of loyalty. So what we're doing is we're in the UK, we are acting for pension fund members, we're bringing challenges with institutional investors. We're really engaging in the process of asking what Nathan referred to as the process test. How are they managing the risks of climate change? Pension fund members are entitled to know that of their funds. If they don't disclose that information, there are legal recourses that we can take. And if they refuse to acknowledge that climate change is a material financial risk to pension pots, then we can also take them to pensions regulator, ombudsman, even to the court.
Wow, so this is going to become quite real for trustees that decide that they're going to ignore it.
Absolutely.
I mean, not only are they going to be like the property companies that don't declare behind the curve, they could be behind the dock in court.
In court, and it's a personal liability as well. So personally named.
That's the UK. Would that also be the case around the world?
Broadly speaking, yes, because the law on fiduciary duty is similar around the world. It's just differs at the margins in the way that it's translated into legislation. So in the UK, actually, the law is even clearer than the common law description of fiduciary duties. So the investment regulations, the Pensions Act are very, very clear about the need to manage the risk and balance it against the returns expected in 30, 40 years.
Right, so this is really quite tough stuff that we're hearing in terms of what the law says, how the law might be enforced, what good practice might look like, and that it's got to look like that for everyone. I will open up to questions on this, because I'm sure there are people in the audience that will be challenged by some of this stuff, as indeed I am as I'm listening to it. But before I do, I'd quite like also just to talk about, if this is where we are today, where are we going and what are practitioners doing to address both this challenge and move forward? I mean, Sophia, you're at the heart of thinking about what we would like the financial world to look like in Europe. Does this feel like fiduciary duty headed in the right direction? Are there other things that we should be doing or will be doing? You know, for example, with your Capital Markets Union and so on?
Yes, thank you very much. Good afternoon, everybody. Sustainable companies and sustainable investment has already been on our regulatory radar screen, I would say, since the financial crisis. We have already introduced new rules for companies to provide better transparency about how what ESG risks they are facing and how they deal with them, and what is their performance and their impact. And we have also started work already, and this is already the new directive, a new EU law is being already negotiated about what investors should do, how investors should behave. So this is a directive which fosters more responsible share ownership, the revision of the Shareholders' Rights Directive, which would introduce new incentives, transparency provisions about how engaged, responsible share owners, institutional investors and asset managers are, and how institutional investors align the long-term interests of their beneficiaries in their asset management mandates, and how they take ESG issues into account, and so on. Now, this is not the end of the story. We have now launched a big regulatory reform around capital markets. This is the big Capital Markets Union project. Part of this is sustainable capital markets. The very idea is to develop capital markets in Europe, because capital markets are relatively underdeveloped compared to other leading economies. But it matters what kind of capital we speak about. So sustainable capital markets are part of this regulatory reform agenda. The action plan itself, which was adopted in September, speaks about a number of measures that we want to propose, but there is already still a lot of assessment evaluations to be made around what barriers are there for investors having a more long-term and sustainable approach to investment. And we are very likely launching a public consultation on these barriers in the coming weeks. Fiduciary duty will be part of this assessment.
Yeah, so I'm hearing from you again. It may be slow, and regulatory processes I know are often 2 steps forward and 1 step back again. But it feels like it's moving in the same direction in terms of some expectation moving up to enforcement of responsibility through the investment chain. And I'm going to come back to the reality of all of this in just a minute, but I wonder if I could just talk to Helena and Wilhelmine a little bit about what it is that their institutions are doing. So Helena, 500 billion euro investment group at BNP. Tell us about what you're doing and whether it meets what Nathan and Alice would be requiring, or where have you got to?
Thank you, David, and good afternoon, everyone. Over here today, we share the strong conviction that we ought to limit global warming to a maximum of 2 degrees. We just heard how this is not only in our vested interest, but also it is our responsibility, and we might breach our fiduciary duties if we don't do so. So this is why the overall objective of our newly strengthened climate change strategy is precisely to align our business to a 2-degree scenario. Now, how do we plan to do so? Our strategy is threefold. First, we are determined to measure our carbon footprint. Now, I'm not talking about our building energy consumption or traveling, I'm talking about the carbon footprint of our funds. Secondly, we want to measure them, of course, to then reduce them. So secondly, reduce them. And last but not least, we aim to use our leverage, our power to influence the companies we invest in to do likewise. But let me deconstruct it a little bit more. So firstly, as investors, what we ought to do at the very beginning is to understand, identify, and measure carbon risks. You cannot manage what you cannot measure. Now, although we've been working on this for a while, it's been thanks to the Montreal Carbon Pledge, which is actually run by the PRI, the Principles of Responsible Investment, that we got our final push, and we actually committed publicly. We did so in May, and we are very pleased to be one of the first mainstream fund managers to do so. And last week,
just explain for people in the audience just exactly what the Montreal Pledge says.
Absolutely. So the Montreal Pledge actually encourages all of us investors to commit to publish our own carbon footprint, the carbon footprint of our portfolio. And this is what we did actually, and we are actually 120 investors already, representing over 10 trillion of assets under management. So last week we did so for 26 of our funds, and this is more or less happy to share with everyone how it looks, one of the reports, and it tells everyone how many CO2 emissions you actually emit for every 100 euros that we invest in the fund, and it provides you a lot of more detailed information. Now, you might be wondering, why 26? Well, we haven't gone further because we didn't have enough data to publish the carbon footprint to actually measure of the rest of the funds. So the Montreal Carbon Pledge has not only been critical in giving us that last push, but also you have to understand that it's a platform where all of us investors, we're working together, we share experiences, and we help each other to address the difficulties that we encounter. Now, the second pillar of our strategy is, well, this is all very good because measuring is the first step, but it's only the means to an end. The end being reducing your carbon footprint. So for that, we joined the Portfolio Decarbonization Coalition, which is for decarbonization, what the Montreal Carbon Pledge is for measuring. And we joined that recently. We started by decarbonizing 18 billion of our assets. Decarbonizing meaning either they are coal-free and or carbon risk, carbon performance. It's a key element or variable for deciding whether or not a company is investable. We also have developed our expertise and methodology to provide customized solutions to our clients. At the end of the day, we're an investment fund, investment manager. Our clients to themselves decarbonize their investments. Last week, we did it for a big French pension fund, FRR, and we decarbonized 600 million euros of their investments. Finally, what we're doing is we're developing a tool for all our fund managers in which they can know exactly what is the carbon impact of selecting company A towards selecting selecting company be on the portfolios, so they're fully aware. Now, ideally, the day that we have a full-on carbon price, that will be in financial terms, and that will be, I think the impact will be much higher. Now, we're doing this in parallel with increasing our investments on green technologies and green bonds. We have almost 3 billion. Now, the question is that enough? Well, to be perfectly honest, no. This is just the very beginning of a long way. This is a road, where actually, have a lot to do. But at the same time, I want to highlight the fact that we won't be able to meet our targets and commitment, whether that is with the Montreal Carbon Pledge, the portfolio disclosure, the carbonization coalition, or our alignment to 2 degrees, if the companies we invest in don't do likewise. And this is why the third pillar of our strategy is to really reinforce our engagement strategies. By engagement, I mean the power we have as shareholders to influence the companies we invest in through our vote, through our dialogues with them alone, but also collaborating with others. And for us, this is going to be a key driver. Until now, we concentrated actually on the real estate sector and the energy sectors. Now we're going to, starting in January 1st, extend it to all sectors. And I will finish by simply highlighting the invaluable and how instrumental organizations like the PRI, the Institutional Investors Group on Climate Change, or the UNEP have been for us investors. Because despite the fact, we're pretty big. 500 billion, it's not peanuts. And yet, we cannot actually really make a difference unless we work alongside other investors. And those organizations are helping us to do so.
Thank you very much, Helena. And Wilhelmina, if I can just hear what MN Services is doing. Now, MN, you manage ultimately 2 million Dutch people's pensions, I think, or say some very large number. Anyway, I'm always struck by the degree that when you have these huge numbers that the financial industry talks about, they always talk about it in euros or dollars. I was quite impressed that MN talked about it in terms of people, but it comes to about 100 billion euros or something like that. But it's 2 million people's savings. How do you manage that?
Well, yeah, we have 115 billion under management, and we do take care of the pensions of about slightly more than 2 million people. And we are also very proud signatories of Montreal Pledge, of the Portfolio Decarbonization Coalition, and a very active member of the Institutional Investor Group on Climate Change. Now, if I tell you a little bit more about what MN is, it might make that message more powerful to you. Because who does MN represent? It represents the heart of the industrial and maritime backbone of the Dutch economy. That is traditionally a very high CO2 sector. Yet, in the last year, and it's not much longer, in the last year, we have moved really aggressively to designing climate risk management strategies for the funds that we, our client funds that we manage. So I think that really reinforces that this is no longer a niche. This is very mainstream. So it is, we have embraced it completely that this is part of our fiduciary duty. Because simply from a risk-return perspective. But there is also another perspective, and it ties into the people side of it that maybe I'll just touch upon. To metal industrial workers, when they retire, in addition to their state pension, which is maybe 400 euros a month, they get on average between 7,000 and 8,000 euros on a yearly basis. That is not a huge amount of money. Those people relatively spend quite a lot of money on basic needs like food, like water. Those sectors are very prone to inflation due to climate change stress. So not only do we want to look about their financial risk return in terms of what we pay them when they retire, we are very interested in what that money will actually buy them. So I think this is a very new perspective,
that we want to make sure that they can actually spend that money that they have earned after a lot of years of hard work on things that they are, that they enjoy doing, and not only on food, on paying high water bills, on maybe not being able to afford health insurance because, people suffer from air pollution. And how does that manifest itself? Well, MN is a very broadly invested company in traditional benchmarks. And increasingly, we've started to filter out the last 10% that we don't like. And then we've engaged with the others that we hope, to change their position on certain topics. And people are kind of scratching their heads and going, is this really rational? Maybe we should just become much more active and actually start actively choosing. And that is where you see the movement in the Netherlands going, that it's away from benchmarks and much more towards impact investing and being much more critical who we do business with. Some of our colleagues are saying companies need to start auditioning for us to do business with them. A last word maybe on the regulation, because I think that is a key theme. So the Financial Stability Board came out with a very interesting announcement that there's going to be a voluntary task force headed by Michael Bloomberg to look into the exposure of climate risk to companies. And in my former job, I worked for the Dutch Treasury, so I know how these things go. First, you start with a voluntary task force, and then, it might end up, it is imaginable that it might end up more concretely anchored in, financial regulation. All of a sudden, it doesn't become a choice anymore. We have to then. And I think that is interesting to think through what it means when at a certain point, institutional investors, fund managers, other asset owners, just to comply with bottom line regulation, need to put companies against that 2-degree or 1.5-degree, which is currently in a negotiation text metric. It's an interesting world. I'm fascinated to see where it'll go.
Thank you all very much. I'm going to open this up to questions. I'm going to start with mine, but please raise your hands if you have a question. Let me just do this one first, which I'm sure that anyone from the outside world would be thinking about, which is, come on, we still have a finance industry that isn't close to financing what it is that we need for a sustainable world. We have a finance industry where half the trades that are made on the US stock exchanges are for less than a few minutes. How can it conceivably be that the finance industry can be saying that it's really putting pressure on companies to do the right thing and to invest in a sustainable fashion? It has to be nonsense. Is that right? I'm going to ask you. Yes.
Yeah, I agree. There is too little happening. I've heard amazing things from all of you, but you're the leaders, and there's a lot of laggards out there. This is why we're using the courts and the rule of law, because legal cases can have far-reaching consequences. One precedent means that directors and trustees around the globe can, either in the UK, they'll be legally liable, or it can have persuasive influence in other jurisdictions. So I agree, I think a lot more needs to be done, and that's why we're using the courts.
So there's good guys and there's bad guys here, and we've got the good guys here. Is that right, or is now you're shaking your head, Willemien? There's a question then at the back here and a question at the front here if there's someone with microphones taking them around, and there's two in the middle here, so we'll get lots of questions. But Willemien, you would say it's not that you're just the good guy.
No, like a short reaction. I really don't believe to divide the world in good guys and bad guys. I mean, I think there are people that have access to different information and different insights and then come to their own conclusions. So I think it's much more a matter of making sure that the different rationales that are driving this, that the different data is out there in order to persuade and just convince people on a very rational basis that this is the right way to go. And I really hope there is no good or bad people, but that we can come together as a group on this, because it has to be a broad movement.
Okay. So a question here, and if we have more than one microphone, I'll take more than one question at a time. If we don't, let's do them question at a time. Sir.
Great. Ian Monroe from Stanford University and Etho Capital, and just building off some of your comments on good guys and bad guys, and that it's really much more about just we can't manage what we don't measure in accounting, and we all have a little bit of good and bad, and just getting the systems out there. What I've been doing with my Stanford research and also with Etho Capital is looking at quantitative climate performance data and creating investment funds and indexes that optimize for climate leaders, and those climate leaders seem to financially outperform. Climate laggers seem to financially underperform, but the kind of quantitative carbon data that we're working with still isn't getting standardized in terms of the accounting. And there was this effort led by UNEP-FI and World Resources Institute to standardize what's been termed finance emissions, the full scope 1 through 3 carbon emissions per dollar invested. It seems like that effort right now is getting primarily stalled by big banks that have realized that if we have these voluntary standards, picking up off what you said about Bloomberg's new initiative, voluntary can quickly become mandatory, and big banks realize that their carbon footprints will go up by several orders of magnitude once finance emissions are part of those calculations. So my question is, how do we get over the resistance points to have standardized carbon calculations, and ideally other sustainability factors and climate adaptation factors as well, incorporated into investor decision making so it can be done in a standardized and rational way? Do you see banks and others as being challenges and obstacles to overcome? And if so, how do we get over those challenges?
And Helena works for a big bank, so we can definitely ask her this question.
Okay. I think there are two responses to your questions. The first one is around, if I understood correctly, to what extent banks might oppose, yeah? And I think there is a legitimate reason why sometimes they oppose, yeah? I'm not saying that that is always the case. Let me explain. Like, we are now, as I said, we're really working, we've been working for a long time in order to built our methodology to report on our carbon footprint, yeah? And not long ago, Mercer, the consultant Mercer, they did a scenario, actually it was with the IGCC, I don't know, yes, you remember. And basically they took the same portfolio, and they used 3 different methodologies, and to be honest, the results were 3 totally different carbon footprints, yes? And so we do have a serious methodology problem. It's not only around the data that you get reliable, but also different companies measure totally different. We realized that we have been very exposed to Danone, and Danone actually has developed an amazing methodology that they count the carbon footprint from the cows from the very beginning all the way up to the north. So if we actually excluded Danone, our performance apparently was brilliant. But the only difference why it was higher, it was because actually they were going farther in the reporting. So there are serious problems in terms of methodology, and this is why I highlighted the great work, you know, the great thing about working with others, because we can address the difficulties we're encountering. And this leads me to my second response, which is, I think that what we need to do is work together with the regulators, the institutions, you know, and the academics to actually standardize methodology.
But Helena, I think your question said that there are other people that are lobbying against this happening. And what is it that we're doing to stop the people that are lobbying against this happening?
Okay. Well, I can only speak for BNP Paribas, and as far as I know, we haven't at all blocked it, because we are actively working on that. Maybe you want to pick up on that? Yes.
I would point out one other initiative, at least from the investor perspective, that I think is trying to tackle this challenge, which is an organization called SASB, the Sustainability Accounting Standards Board. And they are helping to identify the material sustainability KPIs on an industry basis to allow for their inclusion then in SEC form filing. So is it a direct sort of combative stance against the issue that others might take? No, but it's helpful from the investor perspective because what they're doing is allowing data to be aggregated and compiled in a way that's consistent, comparable, and historical. And with that, you can then track and more closely allocate capital aligned with sustainability issues going forward.
That's great. I had somebody as well saying, can we just be a little bit clearer as we're speaking and maybe put the volume up a little bit? Is that better? Speak into the microphone. Great. The gentleman at the front here.
I'm Arunava Mukherjee from a company called Tata Cleantech Capital. So I have two questions. One is, in our company, we have IFC, International Finance Corporation, as one of the equity holders. So essentially, being a project finance company in the energy space, we are required to follow what is called as the SEMS framework, so of the World Bank. So I was just wondering whether the panel is aware of this framework, and because it seems to be fairly well known. And I have a sort of a related question. There is also something called as the Equator Principles. So we have many banks who have signed on the Equator Principles, and whether how does that relate to what you're saying now?
Okay, that's great. And then there's a question at the back there, and there's a question at the front here. I'll try and answer your question first, and then we'll see if we can do two, and I'll offer the person here my microphone. But do you want to answer that question about IFC, Nathan?
Well, I'll take on the last three questions, if I may, very briefly. The Equator Principles are known, but not effective for this task. To go to the gentleman's question over here, the investors are going to go first, the banks will go second. And I think that will work just fine. And part of the reason that is happening is because of the pressure on fiduciary duty. A quick advertisement, this is the report, Fiduciary Duty in the 21st Century. Have a look at it, it's guided some of this conversation. And the work that needs to be done there is so critically important that we are, as PRI, delighted to share this project with UNEP-FI and Generation Foundation, and we'll go across 8 countries over the next 3 years to bring all these regulatory frameworks up to scratch the best we can so that they reflect the current practice. And just on the question that David posed about what about the short-termism, what about the microstructures of markets that are leading to this high-frequency trading and speculative investment behaviours, my answer is quite simple. Ultimately, the pressure on climate is a stronger trend than the pressure to short-termism in trading. And so this is the thing that investors need to understand and are trying to respond to in the way they can fulfil their duties. The owners of the capital will need to ensure that their investment decisions are addressing these threats, and they will have to ensure at the same time that the short-term pressures, short-term trading behaviours being conducted on their behalf are reduced and eventually wound out of the market.
Does that answer your question? I'm not sure whether it does.
I was asking about the SEMS framework.
So the IFC and the Equator Principles have been used for a long time on project finance, or now I think are nearly up to 85–90% of project finance, and indeed are now being put into law in places like Peru. They were voluntary before that. I think one of the challenging things that you have is what do you do about all that other finance that sits between both what investors are doing, like MN Services, and project finance, so the bonds that are traded, and whether we can get something in between that covers all of that. But I think it would certainly be true to say we are not comprehensive in all the information that we have right now. Sir.
Phil Vernon from Australian Ethical Investment. Just on the question of fiduciary duty, the traditional way of looking at fiduciary duty I think is potentially a necessary but insufficient way of addressing the incredible sort of challenge that we've got ahead of us. And I say that because it focuses on effectively just looking at the financial risk to the portfolio under management. And if global capital is in fact the dominant force on the planet, should we not be thinking more from a genuine stewardship role, and that is the impact that investment markets generally have on the planet around us. Now, the law actually allows us to think that way. That's my contention. And I think that the way that we currently frame the issue of fiduciary duty being a financial risk, definitely, you know, trustees have an obligation to manage risk. Climate change is a risk, so therefore trustees have to manage the financial risk to the portfolio. But it does actually allow trustees that perhaps aren't bold enough to take greater action to effectively slip into a bit of a defence to say that they've taken adequate consideration of they've undertaken due process, they've undertaken the risk, but the financial risks still predominate, and it prevents them from actually, for example, taking deliberative or normative decisions to adjust their portfolio the way that they might actually have a genuine belief that they should. Now, my contention is that the law, and this generally applies in most jurisdictions, the law actually permits trustees to make ethical exclusions, and I'm an ethical investor, so I obviously come from a particular perspective, but to make ethical exclusions provided that certain conditions are satisfied. And those conditions are that you still meet your fund objectives, that you still are adequately diversified, you meet your liquidity objectives, and that what you're doing is in the reasonable expectation of your investors.
And if you put everything into this just financial model, you miss some of the point, which is that actually what we want is a green, pleasant world for people to be living in, consistent with their ethical standards. And if we just make it all financial, we kind of miss the point.
That's exactly right. And
Great.
On a particular point, though, many trustees will approach it on the basis that if they make a certain decision, they will be judged as if against what they would have otherwise earned had they not made that decision. And that's totally incorrect. And that actually prevents...
Okay. Yeah.
Okay.
Yeah, and I'll have the panel respond. I'm going to take a couple of other questions, but thank you. That was very helpful. There's a gentleman here, and there's a woman off to the right. So the gentleman in the middle, woman to the right, will take the 3 questions, and then we'll do another round. We've got lots of other hands up. Sir.
Thank you. My name is Alex Outar, and I've been working for BNP Paribas for long years. Hello, Helena. And I have a question for Willemijn and for Daniela. Regarding to the difference between SRI and impact investing. So what I'm doing today is helping project owners to find financing for the good projects, have a positive impact. So I'm quite doing kind of pre-selection for you, and someday I will knock on your door asking you if you're also financing projects, not only companies. So we are really talking about project finance and impact investing. So do you do that? In which proportion of your portfolio? And what is the expected return that you expect from a project if you do?
That's great. And then a woman, yes.
Hi.
Thank you.
Christine Sobieski. Dong Energy is a Danish energy company. We have a lot of renewable energy in our portfolio, and we're moving towards an IPO within 12 months' time. So this topic is obviously of increasing interest to us. And we're at the same time moving towards more integrated reporting that is integrating financial and non-financial data in the annual report. So I'm curious as to what you see in the investment community, if integrated reporting has any value in terms of the information on sustainability that companies give, or if investors, they turn to other sources of information such as CDP reporting or ad hoc, providing information to them on an ad hoc basis. What sources of information do they mainly go for, and has integrated reporting any value in that?
Great. So we've got 3 questions. One is, if you just concentrate on the financial, haven't you missed the broader role of trustees, and might you end up where you don't want to end up by pursuing that? Then, as rather separate subject, what information should companies be giving investors that they're really going to use? And then the final question about, if you're investors, are you also investing in impact and projects as well as secondary investments in shares? And does what you say apply to that? Let me start with the first question with you, Nathan. You talked a lot about this being simply a financial issue. Does that miss the point?
No, it doesn't miss the point, because that is how most of the financial supply chain thinks and works. I would agree with the questioner that a trustee has the option to invest in that way, but I would also argue that all investors generally make decisions based on what they believe to be the right information, and so we need to move away from the idea that the only ethical investor is someone who is screening or someone who is making exclusions. The idea here essentially is that all financial investment needs to be ethical investment. It needs to be fully informed of the impact and consequences of the investment, and the investor who has the beneficiary's best interests at heart will find ways to align those. That is still a very functional and useful model for the majority of the investment markets. The other question on stewardship, we've got some way to go to understand where the duty of the state stops and the duty of the institutional investor begins. This is a really important conversation. We're going to need to explore it, but we're not quite there yet, even though I really agree with the questioner's vision on this.
Okay, Alice, you're our lawyer. Would you agree?
Yeah, absolutely agree with what Nathan's just said. And in terms of, I'm a litigator, so I have to look at the law as how it can be presented as the strongest case in court. So I really do need to focus on the financial implications of climate change, because the law is very clear there. But I agree in terms of ambition. I think the way you've framed that question is really admirable. Yeah.
Sophia, did you have a comment?
Yes, I think so far, at least in the European Commission, in the European Union, we clearly did not want to put any public policy obligations on any asset owners. This is clear. They have an obligation to, for example, pension funds to provide good pensions. If we think there is sufficient evidence out there that long-term investing is a good thing for them, shareholder engagement on ESG issues is a good thing for them. Financially, if they already do this would already be a huge step forward. So this is what we are trying to incentivize. Definitely no other public policy objectives imposed on asset owners.
I mean, it is a very challenging question. I remember at Rio Plus 20, the good intentions of saying that we could measure everything in the environment, and the legitimate protests of the people who lived in the Amazon and said, we don't play by those rules. What we have here is priceless. I just wonder whether there's something there that we need to have at the back of our minds, that we don't miss out on something very important. But let me move on to that second question, which was about the information. We have two investors to your right, Sophia. You're doing an IPO. What should you be telling?
The short answer is yes, absolutely. We do value very much integrated reporting. We value both. So on one hand, quantitative data, because obviously we work with quantitative data a lot. So we like your carbon footprint, etc. But secondly, we also value very much to understand what is your business strategy. So in this case, moving forward, where are you going to, where is going to be your business plans, even your investments, looking ahead. Now, to your question about whether we look at it ourselves or through others, I would say both. I would say because we invest, we might be investing in more than 4,000 companies. You can imagine we cannot look at every single data. So we do work a lot with sell-side analysts, brokers, and with research providers like CDP, Sustainalytics, etc. But where we always do, ask companies when we meet with them, and we tend to meet particularly with European companies once a year, it's what their business strategy, for them to clarify, and have that discussion.
Shall I pass it over?
Great.
Thank you.
So maybe I'll just comment on the question regarding difference of SRI and impact and projects. I think we can have a whole session on exactly what the difference is. So personally, I see the transition from SRI to impact investing is from the do no harm, kind of just managing your risks, to actively and consciously doing good. So, actively picking investments that, besides meeting your financial risk return needs, you're contributing something that makes society, in our personal view of our asset owners, which is also an interesting discussion, what do they define as impact and where do they want to make the difference? So there we pick in that space. And measuring it is important. But even if we cannot measure the impacts, if we have an intuition that that is of value, then that is an argument that also resonates.